Welcome to my accounting tutorials. Today we're going to talk about the adjustments in the income for the income statement. We're going to talk about the adjustments for the income statement. Last time we talked about the income statement. We also talked about the balance sheet. The income statement, we said that it's also called the profit and loss account, and the balance sheet we said that it's also called the statement of financial position. So what happens? We also talked about the trial balance. We talked about the trial balance as well. So what happens is when recording transaction in the trial balance, the trial balance only records the amount, it only records the figures that have been available. The figures of the transactions are variable. So for example, if you paid rent by cash with 5,000. This is what is going to be recorded in the trial balance. This is the figure that is going to be recorded in the trial balance. This is just an example I'm trying to give. But there are situations where maybe you are supposed to pay. Instead of paying a 5,000, you are supposed to pay maybe a 4,000. You are supposed to pay a 4,000. Instead of paying a 5,000, you are supposed to pay. Instead of paying the 4,000, you end up paying the 5,000. Meaning there is an extra amount. 1,000 kwacha is an extra amount. So there's an additional payment of 1,000. So the trial balance will just record this. But with the income statement, it has to give a clear information of the company's financial performance in that particular accounting period. So for the expenses, it just looks for expenses that have been incurred and not the expenses that have been paid. But the trial balance only records the expenses that have been paid. But because the income statement gives clear information about the company's financial position, so instead of giving false information, for it gives clear information. That 1,000 has to be subtracted from the 5,000 so that you remain with the 4,000 as an expense incurred. So this is the expense that we are supposed to pay. This 5,000, the 1,000 kwacha becomes an asset. Why? Because once you leave that building where you are renting, that 1,000 kwacha will definitely be given back to you. So this one is treated as a current asset. So this what I've just explained now are what we call adjustments. So let's try to talk about common adjustments. So under common adjustments, we have the prepaid expenses. Prepaid expenses. Prepaid expenses. So under common adjustments, we have prepaid expenses. So this is just an example I'm just from explaining this. What I've just explained now is called the prepaid expenses. You are supposed, so let's say this is an income statement. It has 3 columns. 1, 2, 3. Like I said last time, I said the first column is that's where we do adjustments. So rent, right? Let's see what expenses, and then we have rent. So rent, like we paid, instead of paying a 4,000 that we are supposed to pay for rent, we paid a 5,000 kwacha. And then in additional information, because you usually find additional information at the end of the trial balance. So in additional information, there's what is known as, maybe they have recorded something like rent prepaid. Rent prepaid 1,000 kwacha. Rent prepaid 1,000 kwacha. So what is going to happen here is that this 1,000 kwacha, you have to be deducted from the 5,000 kwacha. This one will appear in the statement of financial position as a current asset. I've already explained. So here you say less prepayment or rent prepayment. I don't know if this is the correct spelling. So you say 1,000. So this one will have to be subtracted and you remain with what? The 4,000. And this is what will be treated as your expense, as your clear expense. So for the expenses, the trial balance only records expenses that have been paid. But in the income statement, we record expenses that have been incurred. Meaning this, the expenses that are supposed to be, the amount of money that they were supposed to be paid for expenses in that particular accounting period. So we have to subtract any additional amount to the expenses so that we have a clear amount of expenses that we have incurred. So this is how it should be treated in the income statement. We also, apart from this, there is also what is known as, but before I go there, expense prepaid is also known as paid in advance. So if you say expense prepaid or paid in advance, it should be treated the same. So now, there's what is also known as the expense owing, or expense in arrears, or outstanding, or expenses due, or expense accrued. They are one and the same thing. So expenses owing, expenses in arrears, expenses accrued, expenses due, whatever. These are one and the same thing. So this means that, so I'll take this example about the same rent. So here is your income statement. Here is your income statement. Hope I'm writing something visible. Yes, so this is your income statement. So here's the situation. In that accounting period, the amount that you are supposed to pay for rent, the amount that you are supposed, so here I will be change it. Instead of put, I'll say, let's say expense owing, or expense accrued, or expense due, whatever. Expense owing, yeah? Yes. So in this case, you are doing your business in this building where you pay rent. It's not yours, it belongs to the government, or it belongs to someone else, or a firm or what. So you are renting this expense, and in this particular accounting period, you are supposed to pay maybe 2,000 kwacha. You are supposed to pay a 2,000 kwacha for expenses, for rent during that particular accounting period. And instead of paying the 2,000, as an expense that you incurred in that particular accounting period, you pay a 1,000. So it will be there in the additional information at the end of the trial balance, you write rent. If you see something like rent owing, or rent accrued, or rent due, 1,000 kwacha. So instead of paying this 2,000, you paid a 1,000 kwacha, according to the information that have been given in the additional information. So you are owing this firm or this person by 1,000 kwacha. But since the trial balance records the amount that has been paid, meaning in the income statement, this has to be so you are supposed to pay a 1,000. You are supposed to pay a 2,000. You pay a 1,000. This is how I was supposed to explain it. Instead of paying 2,000, you pay a 1,000. And then in the additional information, you say rent owing 1,000. So meaning this amount has to be added to this amount so that you can have the total amount of expenses that you will incur. I'll repeat. Rent, if you are supposed to pay 2,000, but you end up paying 1,000, the trial balance will only record this amount that has been paid. But if in the additional information you find rent owing 1,000, meaning this has to be added to this to make the total amount of expenses for rent, or the total amount of rent that you are supposed to pay to this particular person or firm. So prepayment you had, prepayment you subtract, and then the expenses owing you add. So this should be added to this so that we can have the total amount of expenses, the total amount of expenses that we are supposed to pay in that accounting period. So when you add this, so you say add rent owing 1,000. So you add this so that you have the total amount of expenses or total amount of rent incurred. So you have a 2,000. So this is an expense that has been incurred during that particular accounting period, and this is what is supposed to reflect in the trial in the income statement. So apart from that, we also have income. So we are done with the expenses. We paid the expenses and the expense owing. So we also have what is known as income prepaid. Income prepaid. We also have income prepaid. Also income prepaid. So for example, I'll give an example of a situation where maybe your firm is doing a service to another firm, or is it offering a service for another firm. So this firm is your business is offering a service for another business. And after offering them a service, they decide to pay you on commission. So, commission. You help someone to sell bananas, and at the end, after selling them all those bananas, they pay you on commission. That is what is known as commission received, and that is what is referred to as income, because that amount is coming to the business anyway. So there is also what is known as income prepaid. You offer a service, you help the company, or you offer a service to a company, or you help a company maybe sell certain products, and then they decide to pay you on commission. So now, this is the amount that you agreed. You agreed to say after maybe offering them a service, they will pay you an amount worth 1,000. And then after doing that, in that accounting period, after offering them a service, they pay you 2,000. So this 1,000 is a prepayment. This is a prepayment. They are supposed to pay you the 1,000. They pay you the 2,000. This 1,000 is a prepayment. Maybe because they also want you to offer them another service in the next accounting period. So this amount will cater for that expense. So that one, you have to subtract it. You do the same procedure. So that is what is known as income prepaid. We also have income owing. So this one should be subtracted. Like I said, it has to be subtracted from it has to be subtracted from the 2,000 that were supposed to be paid. Because they were supposed to pay you 1,000, they end up paying you 2,000. So this 1,000 should be subtracted from the 2,000 so that it remains the original amount that was supposed to be paid as commission received. So now there's also income. So this 100 kwacha, since they have overpaid you, it becomes a liability. It is now you, the company, the business, who have received that extra 1,000. So it will be treated as the current liability. I explained about current liabilities. So if you want to know more about current liabilities, you can watch some of my tutorials. So it will be treated as the current liability. So now, there is also what is known as the income owing. Wow. Income owing. So now, this is a situation. Your business offers a service to another business. You are paid on commission. You receive a commission after offering them a service. You help them maybe sell some of their products. You offer them a service in any way. And then at the end of the day, they decide to pay you on commission at the end of that accounting period, whatever it is that you've agreed. So now, instead of paying you a 1,000, let me write it here. I will wrap up this. So now, we have income owing. Income owing. You have income owing. So this is a situation. So here, you are supposed to be paid a 1,000 as your commission received. Commission? Spellings. Is this how you write commission? Yes. So you offer a service to this particular firm and they decide to pay you like on commission. So you agreed that 1,000 is what is supposed to be paid as commission. Instead of paying you 1,000, they pay you a 500 kwacha. This is not the amount which they are supposed to pay you. Meaning they still have another 500 kwacha which they are supposed to pay you. So this one, in the income statement, it has to be added. This one, it has to be added. So in the income statement, you have other income, other income. There you have commission received, commission received. So you are supposed to be paid a 1,000, but they pay you a 500. They pay you a 500 kwacha. And then in the additional information, you say commission received owing. So meaning you say add owing. That is another 500 kwacha. You add that and you have an amount of 1,000. I've already explained how this is supposed to be done. So for those that are following, can take time to screenshot this, but the most important thing is to follow what I'm saying, because whatever information that I'm giving you right now, it will apply in a question that will solve for when you solve the income statement at the balance sheet. When you solve a question for the income statement at the balance sheet of a sole trader, this, whatever it is that I'm explaining, will apply. So this is a very important topic that you have to pay much attention to, because whatever it is that I'll be explaining, you have an understanding what I'm talking about. Because some of the terms I won't be taking time to explain some of the terms that I'll be using. I'll just be going direct, assuming that you had followed what I'm communicating right now. So this is how you deal with income owing. Let's talk about depreciation. We also have depreciation. Depreciation, mind you, is another topic. There's a topic specifically for depreciation. We also talk about it. So depreciation, my handwriting is very bad. You have to, if you aren't seeing what I'm writing, should probably find lenses. Yes. So we have depreciation of non-current assets, or you have depreciation of fixed assets. So you have depreciation of fixed assets. So under depreciation of fixed assets, there is what is known. Did I explain? Yes, I explained depreciation. I explained depreciation in my previous tutorials. So watch those tutorials. I won't take time to explain depreciation again. So depreciation. Under depreciation, there is what is known as the straight line method. Straight line method. There's also what is known as the reducing balance method. So now, with this, you calculate the depreciation on cost. Remember the example that the format that I gave for the balance sheet last time. The last time I presented a tutorial, there was a part where it was written depreciation. So that part, that is where you have to record the amount that asset, the amount that has been allocated that is representing how that particular asset has depreciated. So under depreciation, again, if you go back to the same balance sheet, there was a column that was specifically for costs, and there was also another column that was specifically for net book value. I think I explained all those terms, but I'll explain them again so that you have more understanding of it. So the straight line method of depreciation, here we calculate depreciation on cost. Here we calculate depreciation on cost, and the reducing balance method, we calculate depreciation. We calculate depreciation on net book value. Did I explain this? Okay, I'll explain more when you understand these things. They're very simple. So the depreciation on cost. So for example, if you have this is maybe your balance sheet. You say maybe motor vehicle. Is there anything that is there any other asset that I can explain? Okay, you have maybe building. So a fixed asset. You have building or land, whatever. And then this land, the cost is 1,000. So yeah, let me use this. The cost is 1,000, and the provision for depreciation. I will have to talk about them. Okay, I'll talk about the provision for depreciation later. You have the provision for depreciation. So provision for depreciation. When you buy an item, what happens in these big companies? When you buy an item, when you purchase an item, you have to provide depreciation for that item. So you see that, I think I explained this. You sit down and estimate how the amount that you sit down and maybe estimate how that particular asset is going to depreciate. If it's going to depreciate at maybe 1,000, you say okay, maybe depreciation the original cost of that item. Okay, once you start using that item, it goes the process of wear and tear. It begins to depreciate a bit. So you sit down as a company and say, okay, we bought this company as maybe 1,000. Well, we bought this particular item or land, or let me use land instead of building. Let me use a motor vehicle. Motor vehicle. I think this is a perfect example. So we bought this motor vehicle. We bought this land at 1,000 kwacha. So once you use that motor vehicle, you are not expected to sell this motor vehicle at this amount. It has to reduce. So that's also a loss. So now, as a company, you sit down and say, okay, we're going to estimate at how much this particular item will depreciate at. So for example, if that depreciation will be counted annually, then you say, okay, per year this particular item will be depreciation by 50 kwacha. You estimate. That is what is known as provision for depreciation. So in this particular this situation that we've been presented with, we say the accumulated depreciation provision for depreciation is 1,600. So now you are told in the additional information that the provision for depreciation, this is the accumulated depreciation. Can be maybe the next this is how it has accumulated. And you say for that particular year or for that particular accounting period, this amount depreciated by 10%. You understand? So this amount depreciated by 10%. So this is the amount which is depreciated. This is, it depreciated by 10%. So 10% represents the amount at which this particular thing got depreciated. So this one, now under the straight line method, this motor van, this 1,000, this is what is known as the cost. So this one will be calculated, this 10% will be calculated on the cost. So we'll simply say, when you are calculating for depreciation using the straight line method, you'll simply get this 1,000, the cost at which this thing was bought, purchased at, and then we'll multiply it by the 10%. So once you get your calculator, do I have the calculator? I don't think so. I don't think so. So you will have to calculate this. So take this amount by that. Let me get my calculator. So we'll say 10% of 1,000. What are we going to have? 100. So under, so 100. So this one, because depreciation, mind you, depreciation is treated as an expense. So that amount that you spent, okay, this item will be depreciating at this particular amount in that in every accounting period. That will be treated as an expense to the business because you'll be providing for that. So it will be an expense. It will be more like a loss to the business. Those amounts that you'll be spending, providing for depreciation, will be treated, will be the losses to the business. So it has to be treated as a loss. Therefore, it's an expense. So this will be your expense. This depreciation for this particular year will be what? Your expense. So this is how you calculate for depreciation under the straight line method. But under the reducing balance method, you calculate the depreciation on net book value, at net book value. Like in the trial balance, in the previous lesson, in our previous lesson, I gave the format for the balance sheet is something like that. So here we have the cost, the depreciation, and the net book value. So the amount, in this case, our amount for depreciation was what? 100. This is the balance sheet now. And here the cost was what? 1,000. Once you subtract this, whatever it is that you have here will be your net book value. This is just an example that I'm giving. You have 1,000 here, the cost, and you have the depreciation here. So once you subtract this, whatever it is that you remain with is the net book value. So that's a simple example that I can give about the net book value instead of spending a lot of time explaining about it. So now, this is what is supposed to be done. So here, like we have this situation, we will say motor vehicle, Rosie, 1,000, and then we have provision for depreciation. You have 600, the accumulated depreciation. So now, this is what we are going to do. Now I've started explaining the reducing balance method. So the reducing balance method, we are going to get this amount the 600, and then we are going to multiply this by 10%. We're going to multiply this by 10%. We're going to multiply this by 10%. So we have 600 times 10%. We have 60, is it? Yes, we're going to multiply this by, no, we are going to reduce this amount. So this is the expense that we have incurred. So now, what we are going to do is this. Under this, sorry, I forgot something. Under this is what we are going to do. We've been taught to calculate the depreciation based on or using the reducing balance method. As I said, the reducing balance method, we have to use the net book value. So what we are going to do is this. We are going to, this provision for depreciation, we are going to subtract this from the 1000. We are going to subtract the 600, and whatever it is that we remain with 400. So this 400 is where we are going to calculate the depreciation. Like in this case, we've been told that the depreciation is by 10%. So we're going to get this 400 and multiply it by our 10% that we've been given. So when we get this 400 and we multiply it by 10%, we have 40. So this 40 is what is going to be added. This is what is going to be added to our 600, and in total we have 640 as our accumulated depreciation. So this 440 is what is going to be our expense. So this one, we are going to now add this one to this, so that this will become our total depreciation. And when we subtract it from this, whatever amount that from the cost, whatever amount that we are going to remain with is what will be treated as our NBV, our net book value. So this is what we had. This for today we end here. The next time we meet, we're going to talk about the provision for depreciation.